Howdy, howdy, peeps. I am going to present to you Chapter 7, Homeworks 4 and 5. Okay? So, sit back, relax, and enjoy the show. Question number 1. The bond market is larger than the stock market because there are 4 large categories of bond issuers, 4 groups that issue or sell bonds in order to raise money for their entities. Name them. Well, first is the federal treasury. So the U.S. government, every time they run a budget deficit, and a budget deficit is when Congress spends more than they take in from taxes, that's called a budget deficit, they have to finance that, and they do that by issuing bonds, U.S. Treasury securities. Also, there are organizations or entities that are created by the federal government that do federal government work, and they're called federal agencies. They also issue bonds. Then there are state and local governments that issue bonds to do everything from build schools, to build hospitals, to water and sewer systems, and to pay for government services. And so state and local governments also issue bonds. And then lastly, corporations issue bonds. And with the stock market, there's only one issuer in the United States of stocks, and that would be corporations. The definition of socialism is when the government actually owns the means of production, which means that they would own equity. Government does not own equity in the United States. That would be socialism. So, the bond market is larger than the stock market because there are 4 large issuers of bonds: the U.S. government, U.S. agencies, state and local governments, and corporations. All right, number 2, an investor is in the 35% marginal tax bracket. That means they get taxed at 35% on money they make. A municipal bond has a 6% coupon rate. What is the fully taxable equivalent yield, abbreviation FTEY, fully taxable equivalent yield, for this bond? Well, the first thing you need to remember is that the state government and the federal government cut a deal. They do not tax each other's bonds. So, if the state of Arkansas issues a bond and an investor buys the bond, then the interest that the state government pays to the investor is not declared as income on your federal government tax return. If the federal government issues a bond like a treasury and a person in a state buys that bond, then you do not declare that interest on that federal bond on your state taxes. So the tax treatment of federal bonds and state and local bonds are different, so they don't tax each other's bonds. So we have to make an adjustment, and we call it the fully taxable equivalent yield for a state or local government bond. It's called the fully taxable equivalent yield. So how can we compare 2 bonds that have different tax treatment? So the FTEY, fully taxable equivalent yield, equals the coupon rate divided by 1 minus the tax rate. Okay, so in this case, the coupon rate is 0.06 divided by 1 minus the tax rate, which is 35%. And so we're going to divide 0.06 by 0.65, and we get 0.0923 times 100 equals 9.23%. This is the yield that you would have to get on a taxable bond like a corporate bond that after the tax of 35% would have the same yield as the 6% state or local bond called a municipal bond. So if you were facing the decision of either buying a 6% municipal bond or a 9.23% corporate bond, and they both had the same risk, then you would be indifferent. They are equal to each other. Okay? Fully taxable equivalent yield. So let's flip this now and look. So you use this, FTEY, when you know the coupon rate on a municipal bond, and you're trying to figure out what an equivalent yield would be on a corporate bond. Now, let's say that you are given the rate on a taxable bond. In this example, question 3, it's 8%. So now we're given the rate on the taxable bond. In the first example, we're given the rate on a tax-exempt bond. Now the rate on a taxable bond is 8%, and we want to know what will the after-tax yield be. So we're going to multiply the 8% times 1 minus the tax rate. Why would we do that? Well, you have to pay 35% of this in taxes, and you get to keep 65%. So 0.08 times 0.65 equals 0.052 times 100 equals 5.2%. Okay, so you have the after-tax yield on a taxable bond, and we have the fully taxable equivalent yield. Okay, so those are our two tax questions. All right, what determines which bondholder gets paid first in the event the issuer goes bankrupt? Understand that bankruptcy is a legal situation where an entity that owes money goes to a court and files for bankruptcy. And there are many different types of bankruptcies. The two of the more common bankruptcies are Chapter 7, which is liquidation. Liquidation means a company is going out of business. The court will take ownership of the company's assets, will take the responsibility to sell those assets, and will then distribute the proceeds from the asset sales to the people who the company owes money to. And this process of where are you in the line of people who are owed money to by the company? Of course, if a company goes bankrupt and they owe you money, you want to be first in line so that you get paid. And this process is called seniority. Where you are in line is called seniority. The more senior you are, the higher up in the line you get paid first, and that's what you want. The other type of bankruptcy is Chapter 11 or Chapter 13, and this is called a reorganization, where the court will negotiate with the people who are owed, and the company cuts a deal with these people and gets on a payment plan. The company does not go out of business. It continues to operate, and they pay these people off over time. All right. Question 5. What are the similarities and the differences between a sinking fund and a call feature? So these are clauses that pertain to bonds. They are in the bond indenture. The attorney writes them in at the request of the bond issuer. The similarities of a sinking fund and a call feature is that bonds are repurchased prior to maturity. Before the bonds mature or the principal is to be repaid, before that happens, the issuer will buy some part or all of the bonds back. The differences are a call feature is voluntary. A call is voluntary. The issuer can do it if they want to, but they don't have to buy the bonds back. Whereas a sinking fund is an obligation. It is in the contract, and the issuer must, over time, periodically, systematically buy back a certain number of bonds. Next, a call has a specified price. So with the call, it says we reserve the right to buy a certain number of bonds back at a certain price. That could be $1,000, it could be $950, it could be $1,050, whatever the price is specified in the call feature. Whereas with a sinking fund, the issuer goes into the market and buys the bonds back at the market price. So there's a similarity. They both, a sinking fund and a call, involve repurchasing bonds, but there are differences. Call is voluntary, sinking fund is mandatory. Call has a specified price, sinking fund pays the market price. All right, what do you call a bond that has a coupon rate that may change over time? The coupon rate may change over time, and you call that a floating rate or an adjustable rate bond. What limits are placed on those changes? How much can the rate adjust over time? There are usually limits by year. The rate cannot change by more than, say, 1 percentage point in a year. And then there is a limit of changes, how much a rate can change over the entire life of the loan or the bond, typically 4 or 5 percentage points over the life of the loan or a bond. All right, what do you call legal language that protects bondholders from acts of a bond issuer that might be reckless or damaging? Protective covenants is what you call it. You know what a covenant is. It's a promise or an agreement. Okay? So the attorney writes into the indenture language that protects the bond holders, the investors. And there are two types of covenants. One is positive, one type is positive. These are things that a bond issuer must do. For example, if there's collateral involved, they must maintain that collateral, must keep it in good order. Then there are negative covenants, things that an issuer must not do. For example, they cannot sell collateral. For example, maybe they cannot pay their top level of management too much money. For example, maybe they cannot buy another company that is in bad financial shape. All right? So this language protects the bondholders. It gives the bondholders the best chance of being repaid. That's why they have these protections. All right, homework 5. What is a bond rating and what effect does it have on the interest cost of the issuer? So there are private companies called rating agencies. They are private companies, they are not government agencies, and they are paid by the issuers of bonds to assess the financial strength of the issuers and the likelihood that interest and principal will be paid to bond investors, a very important function. They are telling bond investors what the risk is that the issuer will not be able to pay interest or principal. The stronger the issuer is financially, the higher the rating is on the bonds. The higher the rating is on the bonds, the lower the coupon rate needs to be on the bond. So it's risk return. The less risky a bond issue is, the lower the interest rate will be. Risk is measured by the likelihood that the investor will be able to pay interest and principal. The higher the risk that the bonds won't be paid off, okay? The higher that risk is, the lower the rating is. The lower the rating is, the higher the interest cost is. And when you're doing a large bond issue, the rating and the interest cost can cost the issuer millions of dollars. So it's a very important issue. So the issuer of the bonds pays the rating agency, and there's a reason for it, but it causes a problem because it could be a conflict of interest when an issuer pays the agency for a rating. They might flash a little extra bank at the rating agency to try to get a better rating, and that would be to the detriment of the bond investor. All right, what are the two reasons why the U.S. bond market has a larger market value than the U.S. stock market? Well, we already talked about one of those reasons why the U.S. bond market has a larger market value than the U.S. stock market. First, there are more issuers of bonds. Governments Federal government, state government, local governments issue bonds. They don't issue stock. So there are more issuers of bonds than there are issuers of stock. And typically, issuers do more bond issues than they do stock issues. So it is typical for a large company to do 30 or 40 bond issues over their life, whereas they might only do 1 or 2 stock issues. So issuers are constantly out there issuing bonds, borrowing money. But remember that for equity, after they do the initial stock issue, they use retained earnings as their equity, so they don't have to do as many stock issues. So more issuers and more issues of bonds per issuer. Every time the U.S. government runs a budget deficit, they do more bond issues. For these 2 reasons, more issuers and more issues, the bond market is larger than the stock market. All right, let's do some pricing. A U.S. Treasury bond is quoted at 99.5 to 99.6. What price will you receive if you want to sell the bond? What is this price called? So this is important for you to know. Every security has not 1, but 2 prices. A bid and an ask. 2 prices, not 1, for every security. So when you see that Walmart recently traded at $98, you think that's the price of Walmart, but it's not. That is the last trade that Walmart was done at. But Walmart and every bond has 2 prices. Okay? A bid and an ask. Okay? And in this case, the bid is 99.5 and the ask is 99.6. Okay? And so, this is the higher price and this is the lower price. And this is how it works. If you own a bond and you want to sell it, you will get the bid or the lower price. If you are a buyer of a bond or a stock, you will pay the ask, the higher price. And the difference between the bid and the ask goes to the dealer. This is called the spread. This is what the dealer earns for bringing together the buyer and the seller. Now, you need to know that federal treasuries have a very unique and different pricing system. So 99 stands for 99% of par. That would be 0.99 times 1,000. Okay? Now what does this 0.5 stand for? Well, the 0.5 stands for 5 divided by 32. Don't question why, this is just the system. 5 divided by 32, so 5 divided by 32 is 0.15625. Do it on your calculator, 5 divided by 32. So, 99.5 is equal to 0.99, and then you put the 15625 there. Just add it to the right of it. Multiply it by $1,000, which means you just move the decimal point 1, 2, and 3, and you get $991.5625. That is, if you are going to sell the bond, that's what you're going to get. If you're going to buy the bond, you'll get 99.6. You'll pay 99.6, and that's 0.99 and 6 divided by 32. So 6 divided by 32 is 0.1875, I believe. 0.1875? Yes. So you add that here, 1875. You just put that to the right here, times 1,000, and you get 991.875. Okay? So stare at that for a second. It's really straightforward. Not a problem. All right? So now that we've done treasuries, and this holds true only for treasuries. All right. So now, let's use the same price, but now for corporates. So let's erase this here. If you are going to buy the bond, the corporate bond, you're going to pay 99.6, and that is 0.996 times 1,000, and that's $996. 0.996, 99.6 is 99.6% of 1,000. If you're going to sell the bond, you will receive 0.995 times 1,000 equals $995. Okay? All right. So the corporate bonds are much more straightforward, and so are municipal bonds. Okay. Question 7. What 4 components are factored into interest rates? All right. So how do we determine what interest rates should be? So these are the factors that we look at. 1, time. Generally speaking, the longer the time until you get repaid, the higher your interest rate will be. So a rate on a 5-year bond will be higher than a rate on a 1-year bond because of time. 2, inflation. The higher inflation is, the higher the rate of return must be. What is inflation? Inflation is when prices in an economy rise. What does that mean for you? That means $1 today will not buy the same amount of goods a year from now. Let's say inflation is 3%. That means $1 today will only buy 97 cents worth of goods and services in a year. So, if you loan somebody $1 today and they pay you back $1 at the end of the year, the dollar you're getting back is worth less. So, you have to charge at least 3% to get your money back. That's just breaking even. So you got time and inflation. What else do you have? Credit risk. What is credit risk? Credit risk is the risk that the borrower will not pay the lender back. Okay, so you have to get paid for that risk. And then, and again, risk return. And then lastly, the demand for money. For an economy to grow, for companies to grow, companies need what? Money, capital. So when an economy is growing, the demand for money rises, and unless the Federal Reserve puts more money into the system, what will happen to interest rates if the economy is growing? There is a positive relationship between economic growth rate and interest rates. Okay? So if interest rates are rising, it either means that there's more inflation, or it means the economy is improving. So what does low interest rates tell you about an economy? It tells you either inflation is low